We are in the countries that have stronger institutions, stronger rule of law, better protections for individuals and investors.
On Wealth Track, investing in freedom, Perth Toll, the creator of the Life and Liberty Freedom 100 Emerging Markets Index, joins us.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Royce Investment Partners, Baird, Bill Miller, Research Affiliates, Strategas Asset Management, Women Investing in Security and Education, and Matthews Asia.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Several years ago, longtime Wealth Track guest and fundamental indexing pioneer Rob Arnott recommended I talk to another index creator who was just starting out with a different idea. Instead of using traditional market cap weighting based on a company's stock price or fundamental financial metrics like sales, cash flow, dividends, or buybacks to judge a company's weight in an index, as Arnott's Research Affiliates does, this individual started by measuring the personal and economic freedom of the markets where companies were based and weighting them accordingly. The freer the market, the higher the weighting. Her name is Perth Toll. She is founder of her firm, Life and Liberty Indexes, and the index she created is called the Life and Liberty Freedom 100 Emerging Markets Index. In 2019, she launched the Freedom 100 Emerging Markets ETF based on the index. It was named Best New International Global Equity ETF by ETF.com that year and was a finalist for the Best Overall New ETF. Since inception, the Freedom 100 Emerging Markets ETF, with the symbol FRDM, has trounced the benchmark MSCI Emerging Markets Index with over 8% average annualized returns. It has also grown from about 30 million in early 2021. It now has around 800 million in assets. Why create a stock index focused on freedom? That was my first question to Perth Toll.
I grew up in both China and the US. I was born in Beijing, and I came to the US around age 9. I lived, in both countries growing up, and then after college went and lived in Hong Kong. It was when I was in Hong Kong that I started to realize the difference that freedom made in my life and also in the markets in these various places, Hong Kong market versus China market versus US market at the time. I saw that these policies and governance factors in a country doesn't have an impact on the future and the society and the economy of a country going forward. For example, I had a friend in Shanghai who we called Maggie. And she was the same as me in every other way. So we were around the same age. She was just like any of my American friends, except that she doesn't exist on paper. So she doesn't have any Social Security benefits, any school records, any birth certificate. So not even an official name. So because she was born the second child, due to the one-child policy, her parents registered her brother for official existence. So she went to school under, a different surname, and that's how she is going through life. So I realized then that, hey, that could have been me, because she's just like me in every other way. There's now 30 million missing women in China due to the one-child policy, and that's official Chinese think tank estimates. So some have it as twice that. And that's just not something you can recover from in 1 or 2 lifetimes. So this is having a major impact on demographics in China and the society and the economy. So this is one of the things that made me realize that these policies are important and that countries that protect personal and economic freedoms probably will do better over time.
There's a body of research actually that has come out that in fact proves that thesis. That in fact that democratic countries and countries that even that have periods of where capitalism is allowed to flourish do better than authoritarian governments. Your instinct was absolutely correct. So how did you put the index together, and how do you do a freedom weighted emerging markets index?
The first thing is you have to have the data, right? So we use freedom data from third-party think tanks for full objectivity. So we use the Cato Institute and the Fraser Institute's Human Freedom Index and data set. And this is a data set that encompasses 83 different variables ranging from personal freedoms to economic freedoms. And they also use third-party quantitative metrics. So there's really 2 layers of objectivity there. The freedoms, I bucket into three categories. The civil freedoms, which are things like terrorism, trafficking, torture. Women's rights are a part of these. And then political freedoms, things like civil procedure, criminal procedure, freedom of speech, media expression, and so forth. And then things we're all more familiar with, the economic freedoms, things like taxation, rule of law, private property rights, business practices, freedom to trade internationally, and business regulations. So all of these things, there's 83 of them, and they're all equal weighted into a composite score per country. We use that composite score as the main input into our algorithm, which then chooses the freest country set out of the universe and weights that country set according to their freedom levels. So the higher the freedom level of a country, the higher its weight in the index. The lower its freedom level, the lower its weight, and the worst offenders are naturally excluded from the index.
So I know that the Freedom 100 Emerging Markets ETF, so your universe for that is 24 emerging market countries. Once you get the countries that they're ranking in the Freedom Index, do you just take the top 24, and that's the universe that you're using?
Yeah, so we start with a universe of 24. And then we do screen for market capitalization within that universe. So it has to be large enough and liquid enough to trade before it can be freedom weighted. So the eligible universe, it's just those countries that are large enough and liquid enough. So that first step will eliminate the smaller, less liquid countries, like Czech Republic, for example. It's quite free, but it's too small. Peru, quite free, but not liquid enough. Egypt, not that free, and also too small. So those countries are not in the eligible universe. So we go from 24 to about usually 18 after that first step. And then those 18 countries are then freedom weighted according to their freedom weight, the aggregate score, country score from Cato and Fraser.
I'm looking at the top 10, for instance, so Taiwan, South Korea, Chile, Poland, Brazil, South Africa, Malaysia, Thailand, Indonesia, and Mexico. Have you had any notable additions or deletions from of countries in the Freedom Index?
We found that when freedom declines, it does go quite quickly, and when freedom increases, it's quite gradual. So the top 4 countries are typically always there. So those are the quite for Chile, Poland, Taiwan, South Korea. And then the bottom countries are the more borderline countries. So they're more closer to the average of their peers. And sometimes they can be bumped up or bumped down. So we do also have a rule in the index, a buffer rule, that says that if a country is included, it has to go below a lower threshold to be bumped out. But there's also a rule that says if you fall more than 5 points in 1 year on the freedom scales, then you do get kicked out even if you're in the index. So and that's the freedom decline momentum rule. So the only country that's ever triggered the freedom decline momentum rule is Turkey, and that was because it fell too quickly in 2018. This was the fund was established in 2019, so this was before the fund was established, but the index has been live since 2017. So that's the only country that got kicked out due to that rule. But a lot of the borderline countries like Thailand, Indonesia, India, is a big one that sometimes it's included and sometimes it's not. And we get a lot of questions about Brazil, Colombia. These are countries that are kind of sometimes in, sometimes out. Right now, the most notable exclusion is India. And I'm very conflicted on that. So now my personal opinion doesn't matter at all for the index, right? It doesn't factor into the methodology at all. So India has been in previously. This year it's out. I personally think India has great potential. I think the demographics are very favorable. They have a higher population now than China. And I think that they do have a lot more freedom. They're, on par with the average freedom level within the universe. So it's very different from other excluded countries like China, Russia, Saudi Arabia. But India also had some issues. They blacked out the internet in places that had farmers' protests. They had increased repression of the Kashmir people minority, and they have been cracking down on media more. So you see how Modi raided BBC offices because they were going to do a documentary about him. There's talks of extrajudicial killings in Canada. There's just been some issues that have caused their scores to decrease just incrementally, causing them to drop out. But other countries to come in.
I mentioned in my introduction to you that basically that your emerging markets index has outperformed the MSCI emerging markets index by a very wide margin. How has China's exclusion affected your performance over the last 5 years since inception?
China is obviously the elephant in the room when you talk about emerging markets, because at the time that we started, China had about 35% in most emerging markets indices. Now it's down to like 25% because of the performance. So it's declined. And then at its height, it was 41% in August of 2020. China has a very large concentration in emerging markets benchmarks, and that has caused a lot of autocracy drag on those cap-weighted indices. So the reason why it's got such a large weight is because indexes are usually market cap weighted. So China, being the biggest market cap country in the emerging market space, gets the largest weight. And if you don't account for things like freedom, then that's what you end up with. And you end up with a lot of autocracy drag. Never having China in the index has definitely helped our performance. Not always. So you can zoom in on certain time periods. For example, in the beginning of COVID, 2020, first half, China outperformed the world. So during that period of time, we underperformed. So we will always outperform when China underperforms and vice versa. What surprises me now is that at the time that we launched, everybody thought China was always going to outperform. It's not even empirically sound. If you look at China's, like MSCI's China index, right? The MCHI index, that's onshore and offshore shares. It's been around since 1992. If you look at 1992 to now, so since inception performance, that index has returned worse than treasuries. So it's less than 3%.
Which is actually shocking considering what the expectations were that China was going to be the world's most powerful economy. It's now the second most powerful economy by some metrics. But that is astonishing what the performance has been.
Yeah, and I think a lot of that has to do with the autocracy risk of there's very opaque ownership structures. There's very opaque accounting methods. You don't know how, who you're actually supporting when you invest in China and other autocracies. But also, these are companies that do not have the freedom to put their own self-interest first. They can't put their own and their stakeholders' interests before that of the government. So they have to answer to the state before their own business needs. And that's just not a good way to grow companies. And also, the foreign investor structure doesn't help. So there's a lot of returns being siphoned off to kind of state actors versus investors actually being the beneficiary. So foreign investors did not capture any of the very real on-the-ground growth that happened in China in the last 40 years or so. And that growth was, came from an increase in freedom. It came from an increase in the policies shifted from very poor policies under Mao, so abysmal policies where tens of millions of people died in famine, to not so bad policies. And that incremental change caused China to experience a lot of on-the-ground growth in this time period. However, foreign investors did not capture that at all. And so that's why we invest in the freer countries, not only because the companies can put their own interests and their customers' interests before that of the state, but also it's better capture of returns for foreign investors.
As you mentioned, you were born in Beijing. You lived in China until you were 9 before moving to the U.S. How does it make you feel to be excluding the largest emerging market country from these indexes?
I really look forward to the day that China is included in the Freedom 100 Emerging Markets Index, that it's one of the freest emerging markets in the world, because I think that if that happens, if it becomes free, it would be a phenomenal market to invest in. So I absolutely believe in the ingenuity and the work ethic of Chinese people. I just don't like the foundations for growth are not there if you don't have the personal and economic freedoms. The growth is being stifled by the lack of freedom. So I do hope that China will be in the index one day. And yes, I'm from China, so that is kind of more personal to me. And when I first started working at Fidelity in 2004, all of my clients wanted to be in China without knowing that about these kind of autocracy risk issues. I also had some clients who were from Russia who told me, their words, I don't want to invest in Russia because it's like funding terrorism. And look how prescient that is today. So, sometimes when we're from a particular country, that actually gives us more, I guess, insight into what actually goes on there. It makes us more careful when we're investing there, whether it's China, whether it's Russia. I'm sure I have Saudi Arabian friends who would say the same thing. So doesn't matter the country, but I think that having that background there did kind of lead me to kind of this work.
It's a very interesting guiding principle, Perth. There's no question about it. We found out what the country qualifications are. How do you make it in the index, the ETF especially, as a company?
So it's a top-down approach. The country weights are done first, right? And then the country weights do not change with the security weighting within the countries. So we just want to get a good representation of each country that we capture. And we just take the 10 largest, most liquid securities within each market that is included, and we exclude state-owned enterprises. The reason why we do that is to bring that economic freedom theme all the way through. And there's no other factors on there. So when we were developing the index, our feedback from potential clients was, freedom is your main innovation here. If we wanted other factors, like if we wanted a value fund in the emerging markets, we could get that elsewhere. But freedom is your main innovation. So we isolated the freedom factor in this first product to even test it out in the market. At the time, nothing like this existed. So it's a way to see, hey, does freedom work, one, as a factor, and two, is there demand for this in the market if it's just isolated by itself? So we did it that way. The security selection is very simple. It's just top 10 largest, most liquid securities.
Right, and those are cap weighted. So we're again
cap weighted within their freedom weighted country weights.
Yes, gotcha.
Yeah, and so we do have a cap on the cap weighting as well on the security level, because Taiwan and South Korea, TSM and Samsung are going to take up 30% of their market. So we cap the security holdings at 8% at the time of rebalance.
How often does that universe change?
We rebalance once a year in January. And so that 10 securities per country does capture a lot of the market in most of these countries. So for example, in Poland, there was one year that we didn't have 10 securities to choose from that met our minimums and also were non-state-owned entities, because Poland does have a lot of state-owned entities. So we had 8 that year in Poland. Now it's back to 10. So there are minimums as far as market cap and liquidity on the security level as well. So we do capture quite a lot of the market, typically 70 to 80% of each country's market with just those top 10 tradable securities.
So as far as the diversity of the securities and the types of businesses that they're in, is that narrow? Is it more tech? Is it more banking?
So we do have representation across all industry sectors. The less free countries are typically more dependent on one natural resource, countries like Saudi Arabia or Russia, whereas the freer countries have more diversified industries. So we do actually have a higher allocation to financials and to tech.
Your focus on good governance at the government level, I would assume might extend to good governance on the company level as well. Are you a sort of ESG fund?
Yeah, that's a great question. We've never marketed ourselves as ESG, and I've never thought of it as ESG, although of course, because it has that country level governance, we are in the countries that have stronger institutions, stronger rule of law, better protections for individuals and investors. So it is a stronger kind of country governance fund. It's not security level ESG. And 90% of our clients, I would say, use us as non-ESG core in their emerging markets. And also, I think that freedom is a very foundational, it's the most foundational ESG factor. So without that first foundation there in place, if you don't have freedom of speech, freedom of media, freedom of expression, you don't have any kind of independent verification on data, ESG data or otherwise, that is coming out of the government or out of companies. So the data that you have becomes less meaningful to measure the impact of your investments. So first you have to, I believe, have that foundation in place, and then we can talk about other ESG.
Explain again, just what role does the Freedom 100 Emerging Markets ETF, for instance, have in a portfolio? What do you see your position, and what do you do in a portfolio? What role do you play?
Most of our clients do have only one emerging markets holding, and they use this as their one emerging markets holding.
Right. No, so that's very interesting, again, with the exclusion of China and India.
Everyone's talking about India now because the BRICS used to be the main emerging markets country set, right? And now half the BRICS are, basically uninvestable.
More than half the BRICS, right? Russia, India, and China gone, right?
Yeah. So I think a lot of people are talking about India because China's gone, because Russia's gone. But there's 24 emerging markets out there. Nobody ever talks about Chile or Poland and how amazing these countries have done in the recent past. And by recent past, I mean the last 30 or 40 years in comparison to their peers. And this autocracy drag, if you just focus on the largest countries, is very real. And that's what's, I think, added to the appeal of a freedom-weighted strategy.
We always ask every guest if they had one investment that we should all own some of in a long-term diversified portfolio, what would it be?
Yeah, so I actually have two here. Right now, rates are high. We're in an environment where a lot of people have their money in cash. But treasuries, there's tax implications to, owning. There's a new ETF called BOX, BOXX, that uses box spreads to avoid some of the tax ramifications so it's a more tax efficient kind of treasury situation. Another interesting kind of idea that I've seen is intangible value. And intangible value is basically, things like networking effects, human resources, things that are not traditionally value factors in the economy of the future. I think that's going to be having a bigger role. And so intangible value can be applied to all asset classes.
Is there a vehicle for intangible value?
So there's an ETF called ITAN. That's U.S. intangible value. And so both of these funds, just full disclosure, are funds that are run by friends of mine. So that's why I'm more familiar with them.
So if you had to choose one of them, what would it be?
I mean, that's completely different asset classes. So if you have money on the side that you want to keep in cash, that's BOX. If you are a growth investor, ITAN.
The name of your company is Life and Liberty Indexes. So right now you have one index. So are there more indexes in the future?
The things that we're working on, though, are very challenging. We like to do things that don't currently exist in the marketplace at all. So like we did before with FRDM, and FRDM is very hard to follow up on, I'll have to say that.
Is there a way to apply, the freedom metrics to developed markets?
Yes, that's very easy to do. That would not take much time. So we could actually do that anytime. The reason why we haven't is in developed markets, you don't see this level of dispersion in freedom levels that you do see in emerging markets, right? Emerging markets, you have like China, Russia, Saudi Arabia, Egypt, Turkey, Qatar, UAE, and then you have Taiwan, South Korea, Chile, Poland. So it's very high dispersion in freedom levels, and that's where the freedom premium comes from. But there are other ideas in the pipeline.
We look forward to finding out what those ideas are in the future. Perth, you're off to a great start with the Life and Liberty indexes that you've got. So thank you so much, Perth Toll, for joining us on Wealth Track.
Thanks so much for having me.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action plan is one I've made before, but it is totally topical given this week's focus on the benefits of investing in free markets. It was also recently recommended in the Financial Times by one of its best business book winners. This week's action point is read Bill Browder's Red Notice, a true story of high finance, murder, and one man's fight for justice. Browder is the founder and manager of Hermitage Capital Management, which until it drew the ire of Putin and his henchmen in the early 2000s, was the largest foreign investment fund in Russia. Hermitage's Russian business was shut down when Browder and his lawyer, Sergei Magnitsky, asked too many questions about the ownership and finances of some Russian companies. Magnitsky was arrested, tortured, and murdered in prison. An international arrest warrant, the Red Notice, was issued for Browder. He and his colleagues' lives were threatened and still are. Ever since then, Browder has made it his life's mission to bring those responsible for Magnitsky's murder to justice, including Vladimir Putin, and expose their crimes and corruption. A major victory in that quest was the passage of the Magnitsky Act in 2012, a U.S. law which has sanctioned the Russian individuals responsible for his murder and the massive Russian tax fraud he tried to expose. The act has since been expanded globally to include other countries and individuals responsible for human rights violations. There is a reason Perth Toll's Freedom Index countries are outperforming their authoritarian peers. Doing business in an authoritarian country without the protection of the law can put you out of business or get you killed. More companies and investors are discovering it is too high a price to pay. Next week, why influential strategist Ed Yardeni says AI isn't intelligent. In this week's extra feature, how Toll's dream of creating a Freedom Index came to fruition with the help of WealthTrack regular Rob Arnott. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. As you enjoy the Memorial Day weekend, take a moment to honor the servicemen and women who gave their lives to defend our freedom. Make the week ahead a healthy, profitable, and productive one.